Good evening, everyone. Good evening, everyone. So, Daksh, Achal, Nisha, Yani. So, we're meeting on a Sunday evening, right? So, I think we have missed the session on Tuesday. We couldn't take it. So, we have to cover it up today. Well, it's going to be really interesting thing for all of us because we'll be learning something new, some exceptionally good things. Okay. So we have covered like cost of debt using the approximation method and also the YTM or the IRR method. Okay. So that will help us know the other aspects. So now we have to go for calculating. I think we have done cost of preference share also on a approximate method, and in the YTM method can also be applied. Now let us go for understanding the cost of equity, cost of reserves, and then weighted average cost of capital using couple of methods called as based on market value or based on book value. So let's try to understand first the cost of equity. Okay, so cost of equity. Just give me an idea, guys. What do you feel? Equity shareholders, the cost of funds that we get from the equity shareholders. What do you think? What is the cost of it? Is it going to be something higher or is it going to be something very low? What do you think about the cost of equity? Is it going to be the cost of equity is going to be higher than cost of debt and preference share? Or you feel that cost of equity is going to be lower than the cost of debt and preference share? Yeah. What is your perception about cost of equity? Is it going to be higher or lower? It is definitely going to be higher, guys, because equity shareholders are the ones who are taking the residual interest. So equity shareholders are having residual interest. It means they receive their dividends only after payment of interest and preference dividend. And also at the time of liquidation, they get their money back. At the time of liquidation, they get their money back only after all other payment has been paid, or only after all other payment has been made. So, when do you think that this is of this sort? Only when the payment of this sort has been done, then you say that there is cost of, the equity shareholders get their money back. So they are having the residual interest. So since they are having residual interest, they are under obligation to obviously take a greater amount of risk. So since they are having greater risk, the cost of equity is definitely going to be higher as compared to other sources of funds. Okay, so when you say residual interest, they get whatever is left out. Like the dividend that they get is after payment of all dividend to your equity shareholders, to your preference shareholders after payment of interest and taxes, right? So these are the financiers who are going to get the money at the last. They are the last in the line to receive their dues. And the first payment has to be made to obviously the debenture holders or the debt fund providers. Then you have the payment to the tax, and then you give your preference dividend. And finally, whatever is left out is due to the equity shareholders. So they're taking a higher amount of risk. Since they are owners, they are taking a greater amount of risk. And since they're taking a higher risk, they are definitely going to be asking for a higher return, going by our fundamental principle of finance, which is high risk, high return. Okay. So now the challenge is, when these category of financiers we have, who are the owners of the business, understanding what is their expected return from the company is going to be quite challenging, because they don't explicitly speak out what is their required rate of return or how much return they expect from the company. They never speak out explicitly out of, in words. So we have to understand their expectations from their actions, from their expressions, right? So how do we really try to measure that? So there has been a research since more than a century to understand what is the rate of return that the equity shareholders want. Okay. So there have been many models which have been there, out of which few of them we are going to discuss today. Okay. So we'll be discussing few models in our class today. But obviously there is always some disadvantage, some assumption based on that. And all our theories, all our models work well when they are within the models or when they are within the assumptions. Okay. Because as I said, debentures are very clear. They know, they clearly spell out what is the rate of interest they want. Preference shareholders are also clearly spelling out what is the amount of dividend they want, right? In the form of returns, in the form of percentage. But equity shareholders are someone, they don't express it, right? For example, if I ask you, uh, if you are doing your education by borrowing money from bank, right? If you're doing your education by borrowing money from your bank, the bank will explicitly say that, okay, you should be paying us, let's say 12% rate of interest. You clearly know that 12% is the cost for you. Okay. But the same thing when you finance your education from your parents' money, are they going to explicitly tell you uh, the rate of return that they want? Have you ever heard from your parents that we are putting, let's say, 10 lakh in your education, and so you should give us 20 lakh after 5 years? Do they explicitly say that? Or are they really interested in your short-term interest payment, short-term finance payment to them? Of course not. They are interested in your career growth. They are interested in your personal growth. They are interested in your long-term achievements that you're going to get. So same way, equity shareholders, are not someone who would like to get some fixed rate of return, and they explicitly say that no, they are your owners. They are the owners of the company. They are interested in long-term survival of the company. They are interested in making the company in true sense a going concern entity. Or rather, one peculiar characteristic is that the return that your parents want from your education is not limited to small amount of 12%, 15%. They want a return which is substantially higher. They want you to pass your exams. They want you to build a career. They want you to settle in your life, right? They want you to be financially sound. They want you to be, good in having a good name in your society. So these are many things that the owners expect, right? Because they are your parents. Now, of course, the banker is not going to be expecting that thing from you, right? So if you are having some bad habits, the banker is not going to be concerned about that, but your parents are definitely going to be concerned, right? So same way, equity shareholders over here are not going to ask for a fixed rate of return, and understanding that as part is again a big challenge. So there were many studies which have been going on since more than a century, and there are a few simple models and there are a few complicated models. Some of the simple models that we are going to see is in our today's session on this topic of cost of capital. So what are the simple models? Let's try to understand. So cost of equity is essentially the rate of return. This is essentially the rate of return expected by equity shareholders. This is the rate of return that is expected by the equity shareholders. But again, equity shareholders essentially have a different type of equity shareholders are going to have different perception of the company. Some equity shareholders might be interested in getting dividend from the company. Certain equity shareholders might be expected in long-term earnings growth or long-term earnings that the company is going to get. Certain equity shareholders would be obviously asking for a growth rate in the dividends that we are paying. So there are multiple such aspects or multiple type of equity shareholders. So what is the rate of return that you get? So there are different models for this. So let's look at the different models for calculating cost of equity. First up, it depends on what is the intention. What is the intention? If you are intending to get your money invested in equity for the sake of earning dividends, the cost for such equity shareholder needs to be obviously computed taking into account the dividend payments. If it's going to be like long-term earnings of the company, you will look at that aspect. Okay. So first model that we have called as constant dividend model. A very simple model, constant dividend model. You can actually understand that equity shareholders, those who have invested their money for the sake of earnings dividend. So by looking at the pattern of dividend and the share prices, you can identify what rate of return they are expecting. So for example, suppose I give you a data in which past certain year numbers are given as to what was the dividend per share and what is the market price per share. So we have years, let's say 1, 2, 3, 4, 5. We have got 5 years. In the first year, company gave a dividend of 10 rupee. Then the market price of the share at the time of dividend declaration, it was, let's say, 125. Next time, company gave a dividend of 12. Then the market price became 150. Another year, company gave a dividend of 8 rupees. Market price became 100. Then company gave a dividend of, let's say, 16. The market price jumped to 200. And another year, the company made a dividend of 14 rupees. Then the share price was 175. From this pattern, can you identify what is the rate of return that equity shareholders are expecting from the company? Can you just think of what is the rate of return the equity shareholders are expecting from the company? So it's like when the company gave a dividend of 10, people were ready to buy the shares at a price of 125. When the company gave a dividend of 12, they were ready to buy the shares at a price of 150. When it was 8, they were ready to buy the shares at a price of 100. So they were ready to invest 125 to get a dividend of 10 rupees. People were buying, or investors were investing 150 to get a dividend of 12. So this is essentially your investment, and this is your income by making an investment. So if you just compare these, what's the rate of return that has been expected by equity shareholders? How much return? Okay, perfect. I'm getting answers. You're absolutely right, guys. It is going to be 8%. Yes. So KE, which we say, this is simply your income upon investment, right? So formula for KE is dividend per share upon market price per share, or we can say it is simply D upon P, dividend upon price. Right? So D upon P, this is a simple formula for constant dividend model. So you say that what is the rate of return that an investor is expecting? It's going to be dividend upon P. Whatever the dividend is being paid by the company divided by the price, that is simply your dividend. Okay, so this is a simple approach under which we are saying that now underlying assumption over here is you are assuming that the dividend that the company has paid is going to be, consistent forever. So for the next upcoming years, the dividend is going to be a constant thing. That is what you are going to assume under this constant dividend model, right? So this is simple: dividend per share upon market price per share. Now, this formula is for those investors. This formula is for those investors who are interested in dividend of the company. Now, of course, being a equity shareholders, those who want to be there with the company for a long term, those who want to be there with the company for a longer tenure, how is rate of return 8%? You divide every time 10 by 125, 12 by 150, 8 upon 100. So you find every year the market price is such that the income turns out to be 8%. Got it, Daksh? Yeah, so there was a pattern. There's a systematic pattern that we observed over here where we say that the dividend was obviously 8% of the market price. So market price was changing such that the yield turns out to be 8%. Okay, so this is for those set of investors who are this is for those set of investors who are interested in dividend of the company. So they are saying constant dividend is going to be earned, right? So we are going to pay the respective price. Okay, this is one model. This is one of the models that we say, which is constant dividend model. A similar model is constant earnings model. Now, constant earnings model, the formula is similar to this one, but instead of dividend per share, we have to take earnings per share upon market price per share, or you can simply say it as E upon P, earnings upon price. So here we are going to take the existing earnings divided by the market price, which will give you an idea what is your constant earnings. What is the amount of your constant earning? And this is a model which we use generally for those investors who are interested in being a long-term investor with the company. They are not interested in getting this dividend, but these are the investors who want to get a consistent source of income in the form of EPS, because they say, whatever the company has earned, that is ultimately my income. So with that mindset, those who investors you have, for them, of course, we use this formula of EPS upon MPS. Okay. These two are pretty simple to understand. It's like your MPS is the money that you pay, which is the investment, and DPS or EPS is the amount of income that you get. So EPS is the amount of income, MPS is the price that you pay. Constant earnings model. And of course, before that was the constant dividend model. Clear? Simple, guys. So this is pretty simple. Now, we have to look at an interesting part or an interesting model called as constant dividend growth model. This is constant dividend growth model. So this is actually a quite interesting model. Now, this is based on our present value concept. This is based on our present value concept. If I ask you, so what should be the current price of share? What should be the current price of share? Obviously, as I have discussed, whenever we talk of any valuation or any price that we have to set for any asset, it's always and always going to be present value of all future benefits that you get. It's going to be present value of all future benefits that you get. So current price of share should be present value of all future cash flows. But remember, if you say that there's a present value of all future cash flows, what sort of cash flows do you get from a equity share? What sort of cash flows do you get from an equity share in future? What sort of cash flows do we get if you buy a equity shares today? What cash flows you are going to get from the share on in future dates? What cash flows do we get? Can I say we get the amount of the dividend, right? So we get the dividends. Right? The current price of share should be present value of all future cash flows, which is dividends. Of course, if you are intending to hold the share, if you're intending to hold the share for maybe 5 years, then you will definitely say 5 years dividend and fifth year sale price. Now, what if it's a situation that you're not sure when you're going to sell the share? So, of course, in that situation, we will say present value of all future dividends. It's going to be present value of all the future dividends. Okay. Okay. So, let us say now I'm saying that the company is going to survive till infinity. This company is going to be there till perpetuity. So if the company is going to be there till perpetuity, I'm simply going to say the present value of all future cash flows means first year dividend will be divided by 1 plus K, because I'm going to discount it using the cost of equity or the rate of return which the equity shareholders expect. D1 upon 1 plus K plus second year dividend upon 1 plus K square plus third year dividend upon 1 plus K cube, and this goes on till perpetuity. Now the important question arises is, sir, how do we know what is this amount of dividend? Like what is the amount of dividend in first year, amount of dividend in second year, amount of dividend in third year? What are these dividend numbers? What is your assumption with regards to dividend numbers? If you assume that dividend is going to be constant forever, then you are actually coming to this formula, constant dividend model. But obviously, do you expect the dividend of a company to be same forever? Do you expect companies are going to give the same amount of dividend forever? So do you expect that companies will be giving same 1 rupee dividend since last 50 years? No. Obviously, as an equity shareholder, you're not going to be satisfied just a single amount of, the same amount of dividend forever. There has to be something called as growth in dividends, right? Dividend needs to grow. So there has to be growth in dividend. So now that growth in dividend is something which we need to account for. Okay. So if I say that the first dividend is, let's say, D1 upon 1 plus K, or I can say, suppose for example, in year 1, dividend was 10 rupees. What will be dividend in the second year if dividend is growing at, let's say, 8% every year? If your dividend is growing at 8% every year, if your dividend is growing at 8% every year, what will be the dividend in the second year? So your growth is 8%. So tell me, what will be the amount of dividend in the second year? 18, 16. Very shocking. In growth model, K is the cost of equity. K is the cost of equity. This is what we want to calculate. Yeah, what will be the amount of dividend? If 10 was the dividend in the first year and second year we say that the dividend is going to grow by 8%, of course the dividend is going to be how much? What's the amount of dividend? This is going to be simply 10 plus 8% into 10, which is of course 10 into 1 plus 8%, or this is 10 into 1 plus 0.08. This is 10 into 1.08, which is obviously 10.8. So now this particular part, 10 into 1 plus 8%. So next year dividend, can I say it is next year dividend is D1, which is first year dividend, and you just multiply 1 plus G with that. So 10 into 1 plus 8% or D1 into 1 plus G is what your dividend amount is in the second year. Am I right, everyone? Are we getting it? So D2 second year dividend that I will write over here is going to be D1 into 1 plus G upon 1 plus K square. Okay. Can anyone guess what should be the third dividend number? Third dividend number or the dividend for the third year? It will be D1 into 1 plus G. Growth has to be applied for 2 years because for first year it was into 1 plus G. Now for the third year it's going to be 1 plus G square upon 1 plus K the whole cube. And then it just goes on till perpetuity. Of course, you can calculate the numbers, but we are not interested in numbers. We are interested in, this sort of, what do you say, coding in the variable form. So this is your first year dividend present value. This is your second year dividend present value. This is your third year dividend present value. It just goes on till perpetuity because we always assume that a company is going to exist forever. Okay. Now, just try to understand what is this sequence? What is this sequence? Or what is this series? There is a name for this type of series. Can anyone tell me what is the name of that series? I hope you might have done that in your school section, probably at 9th or 10th standard. If not that, we would have also studied in foundation. This is a typical type of progression. Yes, Gayatri, absolutely correct. This is geometric progression. This is geometric progression, right? Okay. So, and this is geometric progression which goes on till perpetuity or till infinity. So what is the summation of a GP till infinity? Do anyone remember what is the formula for summation of a GP series till infinity? What is the formula? Summation of GP series till infinity. Formula was A upon 1 minus R. Right? Correct? So what is A? A is the first term and R is the common multiple. So A is the first term and R is the common multiple. A is the first term and R is the common multiple. So can you tell me in our series, A being a first term, in our series, A being the first term, we can say, sir, A is being a first term, it is D1 upon 1 plus K. And R being a common multiple, what is a common multiple over here? 1 plus G multi upon 1 plus K. So every time you see, it's getting multiplied by 1 plus G upon 1 plus K. And over here also it's getting multiplied by 1 plus G upon 1 plus K. So every time it's getting multiplied by that. So we get this series. So now, finally we can say, so price of the share should be A upon 1 minus R. So A is D1 upon 1 plus K. And the whole thing divided by 1 minus 1 plus G upon 1 plus K. So it is 1 minus R, which is 1 plus G upon 1 plus K. So that's going to be equal to D1 upon 1 plus K, the whole divided by 1 plus K minus 1 minus G, the whole divided by 1 plus K. So over here, you can say 1 plus K gets cancelled. And we are left out with P0 equal to D1 upon K minus G. So from here, your 1 and minus 1 gets cancelled. So you have D1 upon K minus G. or I can say I want the value of KE, right? The cost of equity. I want the value of KE or cost of equity. So I just need to rearrange this. So this becomes like KE minus G is D1 upon P0, and therefore K will be D1 upon P0 plus G. So this G goes on the other side. So we just swap these two, K minus G over here, P denominator, and this is what is finally your cost of equity formula is. So as per constant dividend growth model, we say, sir, cost of equity should be D1 upon P0 plus G. Now what is D1? D1 is dividend per share in year one, or the dividend that you get after a year. P0 is the current market price of the share, and G is the growth rate in share. Okay, so this is a very interesting formula, which is D1 upon P0 plus G. Don't apply your logic over here, sir. Investor is getting the dividend and also the growth. So therefore, we are adding G over here. There is no intuitive sense to that. It is a purely mathematically derived value for KE. It's not that growth is something, the extra return which the investor is expecting. No, nothing like that. Okay, it is simple mathematical derivation where you say that cost of equity is going to be this, and the underlying principle behind that is it's just the present value of all future dividends. Okay. P0, can we call it as net proceeds? Yes, you can say net proceeds, the money that you get by issuing the shares today. Yes, definitely. Now, one challenge that we have over here is, sir, how do we estimate this G? How do we estimate this G or growth value? How do we calculate the growth percentage? Like over here, so you gave us 8%. So we were able to calculate the next year dividend. But then otherwise, other than that, how are we going to calculate this growth rate? Any idea? Anyone can guess? How do we get this growth rate? Because it's quite obvious, I can get the next year expected dividend and I can get the current market price from the observation. But then how do I know what is the growth rate that I expect? Growth rate in dividend that is expected. How do we get that number? Can anyone guess? Yeah. Yeah. To add according to their profit. Okay. Reserve into rate of return. Yeah. According to the profit reserve into rate of return. Okay. Well, this rate of dividend can be computed under two scenarios. I'll give you both the ways. So how to compute growth? There are two things it is possible to this. So how to calculate growth? First method is by analyzing historical dividend. Okay, so first way of calculating growth rate is by analyzing historical dividend. So let's have a look at it. How do we analyze that? Suppose I tell you that 1, 2, 3, 4, 5. Since past 5 years, the dividend per share has been like this. 8 in the first year, then 8.96 in the second year, then it is 10.04 in the third year, then 11.24 in the fourth year, and 12.59 in the fifth year. Can you interpret and analyze what is the growth rate from this? Can you interpret and analyze? Of course, we can say, sir, 8 has become 8.96. So since it has become 8.96, like this has become 8.96. So can I say 8.96 minus 8 divided by 8, which gives us what? 12% growth. Here also you will see same 12% growth. Here also you will see same 12% growth. Here also you will see same 12%. So there is a consistent growth rate happening, and therefore we say the growth rate is 12%. This is by mere observation. Now let me give you another way. Initially you had a dividend of 10, then the dividend became 11, then it became 13, then it is 13.5, and now it is 15. What is the growth rate in dividend? What do you think? What do you think about the growth rate in dividend? How are we going to understand or calculate the growth rate in dividend in this situation? Now, of course, clearly visible, there is no, constant growth rate. There's a different growth rate that is happening. So if I want to give one single growth rate for future numbers, how do we understand that? How do we understand that? Simple way. We have said, sir, D1 should be, can I say D0 into 1 plus G? Or I can say like this. Sir, D2 is D1 into 1 plus growth rate. Same way, third year dividend will be D1 into 1 plus growth square. D4 will be D1 into 1 plus growth raised to 4. 1 plus growth raised to 3. And D5 will be D1 into 1 plus growth raised to 4. So D5 is D1 into 1 plus growth raised to 4. So that is your dividend numbers, right? So this is your dividend numbers. These are essentially your dividend numbers. So you calculate like D5 should be D1 into 1 plus growth raised to 4. Now, when there is no clear-cut idea about what is a growth rate, when you don't have a clear-cut idea, or there you can't see a consistent pattern of growth rate, then I'll have to use this generalized form to calculate the growth rate. So I'll simply say, sir, my dividend in the fifth year is 15. And when we started analyzing, it was 10. So what is the average growth rate that we have? That's simply 1.5 equal to 1 plus G raised to 4. So 1 plus G will be, what's the fourth root of 1.5, guys? Fourth root of 1.5. Yeah. 1.5 fourth root. So you have to basically take a square root 2 times. This is what? 1.1067. So our growth rate is 10.67%. So there is no there isn't any consistent growth rate that is there, but the dividend is growing. So for future perspective, if I want to analyze the growth rate, if I want to analyze the growth rate from the future perspective, I will definitely say that growth rate is going to be basically a compounded annual growth rate, or we just calculate the CAGR by taking by the start value and the ending value. So start value was in first year, ending value was in the fifth year. So obviously growth would have happened for 4 years, and we simply use this particular number. We simply use this particular equation to arrive at the growth. This is the first method by analyzing the historical dividend. Okay. In fact, you can use this method even for this formula. You can use this method even for this formula. Just try it out. See, 12.59 should be 8 into 1 plus growth rate raised to 4. Here, if you solve it, you're definitely going to get the growth rate as 12%. You can just give it a try. I'm just giving you a minute's time. Just try to solve this. Try to solve this. You should be getting a growth of 12%. Just verify it, guys. Giving you a minute's time. Are you getting this 12%, everyone? Yep. 12.59. Is it? You getting it or no? Something else? So 12.59 is equal to 8 into 1 plus g raised to 4. So of course, this goes as 12.59 divided by 8, which is 1.57375 is 1 plus g raised to 4. Then you take 1 plus g is equal to 1.57375 raised to 1 by 4. So fourth root of it. So you have to just take the square root 2 times. This is 1.12. Yes, growth rate is definitely 12%. You can say the growth rate is 12% because 1 plus g is 1.12. So the growth rate is 12%. Okay, got it? So we can use this formula as a standard, or you can say the standardization will be like you have your dn is equal to d1 into 1 plus g raised to n minus 1. Simple. From this, you can definitely calculate the growth rate. Okay. So this is the first method wherein you calculate the growth rate by historical dividend analysis. There's a second method also which we can follow when we don't have a proper historical numbers, or we don't want to go for the historical observation, or we are under an apprehension that the historical growth rate what we see is not going to sustain in future. So if you're under that particular impression that historical growth rate is not going to sustain, then we follow this second method. Second method of growth rate calculation is simply B multiplied by R. The second method of growth rate calculation is B multiplied by R, where B is retention ratio and R is return on investment of new project, or just return on investment, you can say, or sometimes we can also say return on equity in that situation. Okay, let's try to understand this with the help of an example. Suppose we are in year one, and in year one, we have equity share capital of 10,000 and reserves of 10,000. So total capital is 20,000. Okay. So equity share capital is 10,000, reserves is 10,000. So total capital employed is 20,000. Now the company earned, let's say, a profit after tax of 6,000. Company earned a profit after tax of 6,000. Now, is it necessary for the company to pay out the entire amount of dividend? I mean, whatever the earning is there, is it necessary for the company to pay out? Of course not. Right. So company says, let's say you pay dividend 25% of it. So 1,500. So the other part is retained, which is 4,500. So we can say PAT of 6,000. It simply means what's the return on equity for the company? With an investment of 20,000, if the company is earning 6,000, what is the rate of return on its investment? What is the return on equity that the company is getting? What's the rate of return that the company is getting? Is if a PAT is 6,000, what's the rate of return that the company is generating? By investing 20,000, it has earned 6,000. So return on equity is definitely 30%. Right? So 20,000 into 30% is what you want as 6,000. And if I ask you, what is the dividend payout ratio? How much profit is being paid out? 25%. How much is being retained? Retention is 75%. Right? So this is R and this is B. So now what is going to happen in the second year? Share capital will remain same 10,000. What's going to happen to the reserves now? How much is the reserves going to be? What is the amount of reserves? Will the reserves continue to be 10,000 even in the second year? Or the reserves going to change? Is the reserve going to be 10,000 in the second year? Or what should be the new value of the dividend of the reserves? Yeah. Well, reserves will definitely be 10,000 plus this retained earnings of 4,500, right? So reserves is going to be 10,000 plus 4,500. So the total reserves is going to be 14,500. Because this will definitely be the sum total of both the things, which the reserves which you had earlier and the new reserves which you are getting. So total capital employed, which we have, total capital employed that we have is 24,500. So with retention, with the money reinvested, do you expect the PAT to be continuing same even in the next year, or is it going to grow? Because you have reinvested 4,500 in the business. Of course, you assume that the same 30% return you are going to get. So with the same 30% return, how much is the PAT that will be earned by the company? So PAT that will be earned by the company, 30% of your investment. What's going to be the number? 30% of investment, what's going to be the number? Yes. How much is the new profit after tax number with 30% being the return on investment? So 24,500 into 30%. So now your new profit next year, the grown profit will be 7,350. Okay. How much is the dividend that you're going to pay now? As a policy, you distribute 25% of your profits. So how much dividend are you going to pay now? How much dividend are you going to pay now? Yep. 25% of 7,350. So 7,350 into 25%. This is 1837.5. And what is the amount of retained earnings? You are left out with 7350 minus 1837.5, which is 5512.5. Okay. So you have your dividend growing from 1500 to 1837.5. So dividend has grown from 1500 to 1837.5. So now growth in dividend, if you just compute, if you compute the growth in dividend, it is 1837.5 minus 1500 upon 1500. So what's the growth rate that you observe? It is 22.5%. And if I just apply this formula over here for B into R, if I say G is B into R, so this is 30% into 75%. You'll get the same 22.5%. As you can see, the growth rate is same. So the growth rate can be calculated by this second method, this is also called as, technical terms of sustainable growth rate. This is also what we call it as sustainable growth rate, or this is the growth rate that's going to be sustained for a future period, for a longer period. So we have this G as B into R. Okay. Clear, everyone? So that's going to be growth rate is simply B into R. Fine. So that's going to be your growth rate, which is B into R. So growth rate is going to be 22.5% in our situation. Okay, so that completes our third model called as constant dividend growth rate. We have another model called as the realized yield model. And then we will look at something called as capital asset pricing model. First, let's look at this model called as realized yield model. I'm pretty sure you have done this type of thing when we calculated the YTM of debentures in the last session. So in realized yield, we calculate the return earned in past. And then you assume same return will be earned in future. So we say you're calculating the return which will be earned in the past, and also assume the same return is going to be earned in the future. Okay. So assuming that the same return is going to be earned in the future, you calculate the realized yield. So now how do we get the realized yield? Pretty simple. Here, particulars, and let's say cash flow. So in year 0, you made an investment. Year 0, investment was made. Let's say you purchased the share for a price of 1200. So you paid 1200. Then for, let's say, 3 years, you earned dividend. You earned a dividend of 50 rupees in the first year, 60 in the second year, and 40 in the third year. And then in fourth year, you sold the share for, let's say, 1400. So can we calculate the rate of return that we have earned over here? Can we calculate the rate of return using the same YTM method? Using the same YTM method that we have used in the previous session. So just assume, first let's try to get the present value at let's say 10%. Calculate the present value at 10%. So present value at 10% will be what? 50 upon 1.1 plus 60 upon 1.1 square plus 40 upon 1.1 cube plus 1400 upon 1.1 raised to 4. Okay. So just try to calculate the present value at 10%. Yeah, calculate the present value and give me the number. What's the present value at 10%? So 50 divided by 1.1 plus 60 divided by 1.1 square plus 40 divided by 1.1 cube plus 1400 divided by 1.1 raised to 4. This is what we have done in the yesterday's lecture. So you should be able to do it quickly. Okay, so this is what 1081.31. Is it 1081.31? Just check everyone. Let me also try it. Fifty, 60, 40, and 1400. So this is the yeah 1081.31 is the answer. So of course we are not matching that 1200 aspect. So if I want to match that 1200, do I need to increase the rate of discounting or decrease the rate of discounting? Do I need to increase the rate of discounting or decrease the rate of discounting? Of course, the rate of discounting needs to be decreased because we want to increase the value. So take the present value at 5% now. So 50 divided by 1.05 plus 60 divided by 1.05 square plus 40 divided by 1.05 cube plus 1400 divided by 1.05 raised to 4. Then just add it all and then give me the number. Just use a calculator. 50 divided by 1.05 n plus, then 60 divided by 1.05 divided by 1.05 n plus. You have to divide twice over here, divide thrice, and divide 4 times. You will obviously get to know a easier method when you'll be discussing the chapter of investment decision. Right now, you can just accept it as it is. Now, you just need to divide it and get the numbers. Yes. is what? 1288, 1288.38. Okay. So now we can do the interpolation easily between at 5%, the value was 1288.38, and at 10%, the value is 1081.31. We definitely want a percentage for 1200. Okay, so we definitely want a percentage for 1200. Okay, do the interpolation and give me the percentage over here, because we know that at 5% it's 1288.38. At 10% it's 1081.31. So your rate has increased by 10%, and the value has reduced by 1288.38 minus 1081.31, which is 207.07. And of course, we didn't want the value to be reducing by 207. We wanted to reduce it just by 88.38. So for a reduction of 88.38, what should be the percentage change? Yeah, this is 5% change. So what should the percentage change for this? 88.38 into 5 divided by 207.07. 2.13%. So realized yield, or the assumed cost of equity, is going to be 5% plus 2.13%, which is 7.13%. So this is same as the YTM calculation that we have did in yesterday's class. Clear, everyone? Okay, so this was the fourth approach, realized yield approach. We are left with one last but not least and also really interesting method of calculating cost of equity, called as capital asset pricing model. This is what we call as capital asset pricing model. Now, how do we calculate this CAPM, or capital asset pricing model? So capital asset pricing model, it simply is based on the relation between risk and return. Do you think the rate of return that you will be getting from equity share of one company is going to be similar to the rate of return earned by equity share of another company? I mean, cost of equity of two shares, are they going to be same? Cost of equity of, let's say, TCS, and cost of equity of Infosys, or cost of equity of L&T, is it going to remain same, or is it going to be different? Yeah, it is definitely going to be different. Now, the question is, why are the cost of equity going to be different? Why do you think the cost of equity is going to be different for the two companies? What is the reason? What's the reason that the return or cost of equity is going to be different for both the companies? Why do you feel so? Value of company is different and share price determination. No, it's not that capital is different, number of shares is different. No. Why do you think that one company is going to have a different cost of capital as compared to another? Okay, so now my question is, do you think investing in one company is going to be same risky as investing in another company shares? Investing in equity shares of two different companies, does it involve the same amount of risk? Does it involve the same amount of risk? Tell me. Yes or no? Of course, no. Risk is different for different company shares, right? So shares of different companies are going to have different level of risk. So when your risk is different, the return is also going to be different. And that is what is the base for this particular model of capital asset pricing model. So let us understand this capital asset pricing model by looking at three things. We have a risk-free asset. We have overall market performance. And we have our XYZ Limited. Okay. If I talk of risk score, obviously, what's going to be the risk in risk-free asset like government bonds, or in India, you can say State Bank of India, FD, or bonds of RBI. What's the risk in that? What is the risk in that? Zero. Because risk-free security, government can never default. Right? Though many governments have defaulted in the past, but our Indian government have never defaulted on its loan. Never. Okay. So we can say virtually there is no risk in it. So we can say the risk-free asset is going to be zero. I mean, risk-free asset is going to have zero risk. If I say that the overall market is having a risk score of 1 and XYZ Limited is having a risk score of, let's say, 2. So can I say that this company is double as risky as the market? Right? Can I say if your overall market risk score is 1 and XYZ is having a risk score of 2, what does that imply? That simply implies that our company is double as risky as the market. Now let's look at the return. Risk-free asset, you can earn a return of 5%. Overall market, you can get a return of 12%. Okay, so you are taking some risk and you are going to earn 12% from the market. Now, what do you expect the return from the equity shares of XYZ Limited? How much return are you going to expect? Just give me a number. Is it going to be more than 5%? Yes or no? The return that you should get from XYZ Limited, is it going to be more than 5% or no? Yes. Should it be more than 12% also? Should it be more than 12% also? Of course, yes, because the risk of XYZ Limited is double that of overall market. So now we understand how to calculate this return. So if I ask you, what is the risk premium or extra return? Of course, here you don't get any extra premium, extra return. But what is the extra return that you get in the overall market? In the overall market, what is the extra return that you're getting? What's the return that you're getting when you're taking the risk? Extra return that you're getting. Can I say 7%, which is nothing but you're getting 12% from market against a risk-free return of 5%. So you're essentially getting 7% extra return. You're essentially getting 7% extra return as compared to your risk-free asset. Are we correct? Yes or no, guys? Are we all getting it? You're getting additional, instead of 5, you're getting 12% return. Of course, that simply implies that I'm getting 7% extra return by taking the market risk. So this is like 7% extra return 7% extra return by taking risk in market. Now my question to you, what should be the extra return from the company XYZ? Should you be getting the same 7% extra return in this company? Should you be getting the same 7% extra return in this company? Can I say double? Because since the risk is double, the risk premium should also be double. If the risk is double in that company, I should be getting double risk premium. Right? Perfect. We are on the track to arrive at the number. So this should be 2 times of 7%. Right? Or you can say this should be simply double of market. So now my question is, what should be your return? Of course, I say 14% should be the extra return that you should get. 14% is the extra return that we should get. So can you tell me what should be the total return that you should be getting? What should be the total return that you should be getting? Absolutely correct. Daksh, you're absolutely correct. Sir, I should get a minimum of 5% plus the extra return of 14%. So this is going to be like 5% plus 14%. So answer is going to be 19%. Because I need bare minimum 5% return plus the risk premium of 14%. Now this derives as the formula. Sir, our KE was 19% and we said KE was simply 5% plus 14%. Well, this 5% was what? Risk-free rate. And this 14% is the risk premium. Now the next question is, sir, how do we get this 14%? We calculated 14% as what? 2 into 7%. Right? Okay. Further, I will say it is 5% plus 2 into, how did we get this 7%? This 7% was essentially difference between the market return, which was 12%, and the risk-free return. And finally, we can call this as, sir, 5% is the risk-free rate of return that I want, plus beta into market rate of return minus risk-free. This beta is risk of company as compared to market. So this is your capital asset pricing model, which should be like, what should be the rate of return that you should get? Bare minimum risk-free plus something extra called as the risk premium. Something extra called as the risk premium. That's your beta, which is a risk score that you're getting. The risk score, it is going to tell you how much risky your company is compared to the market. And of course, in the market, you are getting this risk premium. So as compared to the market, I should be getting that comparative risk premium. And that's going to be your cost of equity. This is going to be called as your capital asset pricing model, everyone. Okay. So are we good till now, everyone? So cost of equity, we have covered all the 5 models. Okay. So let's take a break now. And after the break, we will meet again to just quickly discuss the weighted average cost of capital. We have discussed how to calculate weighted average in last session, but just to give you 2 dimensions to it, which is the book value and market value, that will be done. And then we will do some practical questions on cost of capital. Okay, so let's take a break, guys. Let's take a break. See you soon.
सर नोट्स अभी तक अपलोड नहीं हुए हैं ऐप पर।
चैप्टर 1 2 के भी?
हाँ, एक भी नहीं हुए हैं।
अच्छा, ठीक है। आई जस्ट इंटीमेट, वेट।
ओके।
यस दक्ष।
सर एक्चुअली आपने जो नोट्स अपलोड किए हैं इस बैच के, वो अपलोड एक्चुअली आपने प्रीवियस बैच में कर दिए, तो मैंने वहां जाके देखा है। सो द
ओके,
डेट्स आर प्रॉपरली एज यू हैव मेंशन्ड इन द प्रीवियस लेक्चर दैट द नोट्स आर अपलोडेड, सो द स्टूडेंट्स आर अनेबल टू फाइंड इन द September 26 बैच।
ओके। तो आई थिंक वो प्रीवियस May 26 एंड September 26 उसमें कंबाइन हो गया रहेगा।
यस, यस, दैट
ठीक
हैज
है।
हैपेंड।
आई थिंक वो कुछ इशू है, मैं करता हूँ साथ में, ठीक है ना? Okay, so we've done cost of equity, cost of debt. In fact, one small thing is pending, which is the cost of reserves. So cost of reserves, it means, of course, we are talking of reserves is ultimately belonging to whom? Reserves as a source of fund, it belongs to whom, guys? To whom does the reserves belong to? Obviously, equity shareholders, right? So whatever is your cost of reserve, that's going to be approximately equal to cost of equity itself. So remember this part, that cost of reserves is going to be equal to cost of equity, because the money which the equity shareholders are given, or the money which you have earned on equity shareholders money and which you haven't distributed, it's going to be yielding the same return. Okay, now let's go for weighted average cost of capital calculation, which is going to be uh, bit two-dimensional thing. So first, let us calculate weighted average cost of capital. Weighted average cost of capital. Okay, weighted average cost of capital. There are two dimensions to it, which we say. It is denoted by KO. One is a book value method or book value weights, and another is going to be market value weights. So, how are they different? Let us first see what are the book value weights. So, book value weights, we'll write down first the capital, which is equity share capital, let's say reserves, preference share capital, and debentures. Okay, so they are definitely going to have some book value. Equity share capital with a face value of 10, preference share capital with a face value of 100, debentures are having a face value of 1000. So in our books, equity share capital is, let's say, 10 lakh, reserves 15 lakhs, preference share capital is 10 lakhs, and debentures 25 lakhs. So what's the total capital employed as per the books? As per the books of accounts, what's the total capital employed? Yeah, what's the total? 60 lakhs. Okay, the book value is 60 lakh. Now definitely we can get the weights. What will be the weights for each one of them? What will be the weights? Get the weights, everyone. Take weights up to 4 decimals. Take the value of weights up to 4 decimal. So how much is this? Weights 10 lakh divided by 60 lakhs. So 10 divided by 60. This is 0.1667. 15 divided by 60 is 0.2500. And 10 divided by 60 again, that's 0.1667. And 25 divided by 60 is 0.4166. Okay. Then we take a total of weights is definitely 1. We have been given the cost. So let's say equity share capital is having a cost of 15%. Same cost applies to even reserves, which is 15%, and preference share capital are having, let's say, cost of 12%. Debentures are having a cost of 10%. So we can definitely do the weighted average as weights into cost. Correct, guys? Weights into cost. So give me the weighted average number. Multiply the weights with the cost and give me the weighted average number. Multiply it and give me the number, guys. Weighted average number. Yep. So what's the answer? 12.417%. Everyone? 0.1667 into 15. This should be 2.5005. Then 15 into 0.25, which is 3.75. 12 into 0.1667, which is 2. And 10 into 0.4166, which is 4.166. So if we just add them all, let's check. 2.5005 plus 3.75 plus 2 plus 4.166. Yeah, 12.1. So this is definitely 12.42. Okay. So 12.42 is the weighted average cost of capital. Now we have another method called as market value weights. Okay. So we have the market value weights wherein you get the capital and of course book value. But now in this situation, we are not looking at book value. We're not looking at the book value numbers. Definitely we will consider book value to start with, but the weights will be based on the market value. Okay, so weights will be based on now market value. So let us say that market price of share is 40. Market price of preference share is 103, and market price of debenture is 996. So we have to first get the market value of each of this. So what is the market value of equity shares now? They're saying 40 rupees per share. So face value is 10. We will definitely having 1 lakh shares. So 1 lakh shares into 40 rupees. So what will be the market value over here? What will be the market value? Market value will be how much? Market value will be how much, guys? Of course, the market value is going to be 40 lakhs. Reserves market value is not applicable because you don't see reserves being sold independently in the market. There is no market for the reserves, right? So reserves, in fact, I can say reserves value is clubbed with the value of the equity shares. The value of reserves is clubbed with the value of the equity share. So this 40 lakh is the market value of both reserves as well as capital. Preference share capital is priced at 103. So this will be 10 lakh 30,000, and debentures are priced at 996 per debenture. So the calculation that we will have over here for this is 25 lakh divided by 1,000 because the face value is 1,000. And then we multiply this by 996. So 25 lakh divided by 1,000 into 996. So that we will get the market value of the debentures. So 25 lakh divided by 1,000 into 996, which is 24 lakh 90,000. And now we get the total. So total capital as per market value is 40 lakh plus 10 lakh 30,000 plus 24 lakh 90,000, which is 75 lakh 20,000. Now here we calculate the weight and we take the same cost, which is 15%, 12%, 10%, and then we do the weights into cost. So I think this is something which we can calculate. We can calculate the weights, get the weights multiplied by the cost, and give me the weighted average cost wise, with the weighted average number. Get the weights and then also the weighted average cost. So that's 40 lakh divided by 75 lakh 20,000, which is 0.5319. Of course, this is not applicable. 10 lakh 30,000 divided by 75 lakh 20,000. That's 0.1370. Then you have 24 lakh 90,000 divided by 75 lakh 20,000, which is 0.3311. Total is of course 1. Just you have to do now the weights multiplied by the cost and give me the weighted average cost. So this is the second method or another way of calculating weighted average cost. we need to follow which one, guys? Should it be book value or market value? Well, the question will specify which method is to be used. Practical point of view, we can definitely say from the practical perspective, market values are market value weights are used because that reflects what is the market expecting out of you. Okay, so just give me this weighted average cost, everyone. Calculate the weighted average cost. You have the weights, you have the cost, you just need to take the sum product or multiply it and then just add them. So that's what, 12.93? Is it 12.93, everyone? $12.93. Is it, everyone? Are we getting this 12.93? Okay, fine. 12.93%. That's your market value weights. So that completes our discussion with regards to the cost of capital. We've done few numerical questions also, but let me just come up with some more numerical questions. Okay, so let us take let's take up this question, guys. So the capital structure of Shine Limited as on 31st March 2024 is as follows. So we have share capital, 15% preference share, retained earnings 32 lakh, 13% convertible debentures, 11% term loan. Total 2 crore is the capital. Additional information is provided with regards to company issued 13% convertible debentures of rupees 100 each on 1/4/2023. So it's been a year that you have issued these convertible debentures with a maturity of 6 years. So when it was issued, there was a maturity of 6 years. At the time of maturity, debenture holders will have an option to convert the debentures into equity shares of the company in the ratio of 1:4, which means 4 shares for every debenture. Market price of the equity share is 25 each as on 31st March 2024. And the growth rate of share is 6% per annum. Okay, so growth rate of share is 6% per annum. So every year the share price is growing by 6%. Preference stock redeemable after 8 years is currently selling at 150. Prevailing default risk-free interest rate on 10-year Government of India Treasury bond, Government of India bonds is 6%. Average market risk premium is 8%. Beta is 1.54. We have to take the corporate tax rate as 25% and rate of personal tax as 20%. Now, this is something new when we want to compute the cost of retained earnings. So you have to calculate the cost of equity shares, preference share, convertible retained earning, and term loan. And then, of course, after that, we'll do the weighted average cost also. So let's first take off the situation of equity share capital. So we'll say calculation of cost of equity. Calculation of cost of equity K. Cost of equity will be calculated as company issued these shares, and we have this certain numbers given to us, like the risk-free rate is 6%. Now this market risk premium of 8% is given. So what is this 8% number? What is this 8% number? RM? No, it is RM minus RF. Because they are not saying market return, they are saying market risk premium. So market risk premium is definitely the return over and above the market rate. I mean, over and above the risk-free rate. So RM minus RF is 8%. And then we have the beta as 1.54. Beta is 1.54. So we can calculate the KE by using capital asset pricing model. So capital asset pricing model will be RF plus beta into RM minus RF. So RF plus beta into RM minus RF. Just substitute the values over here. RF is 6% plus beta is 1.54. RM minus RF is 8%. So what's the cost of equity? What is the cost of equity? What is RM minus RF? So what's this number? 8 into 1.54 plus 6. Okay, so that's 18.32%. Right, so you do 1.54 into 8, and then you add to that 6. So 18.32 is the answer. Actual BODMAS rule, first you need to multiply this and then add this. That's okay. Then cost of preference shares. So we'll say calculation of KP, which is cost of preference share. So cost of preference share, what about the preference share? We have redeemable after 8 years. So we have over here, N is 8. Current selling price is 150. So net proceeds is 150. And preference dividend is 15. Redemption value will be definitely 100. Okay. So we can calculate the cost of preference share by using the simple formula. Cost of preference share is preference dividend plus redemption value minus net proceeds upon N, the whole divided by redemption value plus net proceeds by 2. So just substitute in this and get the cost of preference share. Give me the cost of preference share from this is yep. So this is 15 plus 100 minus 150 upon 8, the whole divided by 100 plus 150 by 2. So that's cost of preference share. Now the next is cost of convertible debenture. Now that is something really interesting. Calculation of cost of convertible debenture. Convertible debenture. Well, the formula is still going to be the same. There is a cost of debt is interest into 1 minus t plus redemption value minus net proceeds upon n, the whole divided by redemption value plus net proceeds by 2. Okay, this is going to be the formula, but we can write down certain values from this, like 13% convertible debenture. So we can get the amount of interest also. So in this, to substitute, we have interest as 13 and it was issued a year before, obviously at a price of 100 itself. Now current market price, do we have the current market price of the convertible debenture? Well, there is no current market price, right? So we can definitely say net proceeds is going to be 100 itself, which is the issue price. Okay, so at maturity, the debenture will have an option to convert to debentures of equity shares in the ratio 1:4. Okay, that's fine. So we have N as 5 years. Now the only thing that is unknown is the redemption value. Now what is going to be the redemption value? Redemption value is simply going to be 100 or value of 4 shares. So 100 or value of 4 shares, whichever is higher. So redemption value is 100 or the value of 4 shares, whichever is higher. Okay, so redemption value is 100 or value of 4 shares, whichever is higher. So first I need to get what is the value of 4 shares or value of 4 shares on maturity. Okay, so let's first try to get that. So value of 4 shares on maturity. What is the current market price given? Current market price is 25. And these shares are going to increase at 6% every year. So you can say value of shares on maturity will be 4 into 25 is each share value. This multiplied by 1.06 because it's going to grow at 6% every year. So after 5 years, what is the share price of each share? That's going to be 25 into 1.06 raised to 5. And then the whole thing is multiplied by 4. So what's the value of 4 shares on maturity? Yeah, what's the value of 4 shares on maturity? It's what? 133.82. 133.82. So value of short shares on maturity is 133.82. So of course the redemption value is 100 or 133.82, whichever is higher. Obviously it is 133.82. So we get the redemption value as 133.82 and the tax rate is given as what? Corporate tax rate is 25%. Corporate tax rate is 25%. So we have the uh, tax rate as 0.25. Now, of course, we can just substitute the numbers over here. So interest is 13 into 1 minus 0.25. 13 into 1 minus 0.25. Plus redemption value is 133.82 minus net proceeds of 100 divided by 5. The whole divided by 133.82 plus 100 by 2. You can solve it and get the cost of convertible debentures. Get the cost of convertible debentures. Yeah, what's this number? 14.13%. Perfect. So that's your convertible debentures. Now, cost of retained earnings. So cost of retained earnings We know cost of retained earnings is generally going to be cost of equity. But if we have the number of personal tax, then this is going to be cost of equity into 1 minus personal tax rate. So we get the cost of equity as 18.32. So as a equity shareholder, you expect 18.32. But if reserves are distributed to you, you would not be able to earn to this 18.32 because you need to pay 20% tax on that. So if you earn 18.32, on that you're going to pay out 20% tax. So this is going to be 18.32 into 0.8. So that's 18.32 into 0.8, which is 14.66%. So equity shareholders are going to have a cost of reserves as 14.66%. So cost of reserves is 18.32 into 1 minus 0.2, which is 14.66%. Got it? Right. So in case of retained earnings, it's going to be not equal to K, but it's going to be K into 1 minus personal tax rate, which is 14.66%. Okay. Okay. Then coming to this part, cost of term loan. Now we know the term loan is 11% term loan, which is to the tune of 20 lakhs. Now this, of course, 11% term loan is to be computed cost. And over here, the cost of debt for the term loan is simply going to be interest rate into 1 minus tax rate. So interest rate is 11% into 1 minus tax rate is 25%. Okay. 11 into 1 minus 0.25. What is this? Eight point 25%, right? So that's 8.25%. Okay, so we are done with the calculation of all the costs. Fine. Okay, let's do this question now. 14th one. For term loan also we have to do, we have to write KD. For term loan also we have to write KD only. Beta Limited has furnished the following information. Earnings per share 4 rupee. Dividend payout is 25%. Market price is 40. Rate of growth, so rate of tax is 30%. Growth rate of dividend is given as 8%. The company wants to raise additional capital of 10 lakh, including debt of 4 lakh. The cost of debt is 10% up to 2 lakhs and 15% beyond that. Compute after tax cost of equity and debt and the weighted average cost of capital. Okay. So now for KE, for cost of equity, we need first up dividend, which is the dividend expected in the next year. So dividend is going to be 4 earnings per share into 25%, which is 1 rupee. So earnings per share is 4 into 25%, which is 1 rupee. So dividend is 1 rupee, right? And then we have the dividend payout ratio, sorry, market price, which is P0, is 40 rupees. Growth rate is 8%. Can you calculate the KE by using constant dividend growth rate model? So constant dividend growth rate model, KE. KE. What will be KE? It's going to be D1 upon P0 plus G, right? So D1 is 1 upon 40 plus growth rate of 0.04. So 1 upon 40 plus 0.08. So 1 divided by 40 is 0.025. So 0.025 plus 0.08, which is 0.105. That's 10.5%. That's 10.5%. So K is 10.5%. Okay. Now we want to raise additional 10 lakhs. Jisme, you are going to have a debt of 4 lakh. Cost of debt before tax. Now this is something interesting. Before tax cost of debt is 10% up to 2 lakhs and 15% beyond that. So we'll have to get cost of debt. Cost of debt, it's going to be 10% into 2 lakh plus 15% into the remaining 2 lakhs. Right? So this is, of course, the cost of debt, which is before tax, and this whole thing is divided by 4 lakh. So 10% into 2 lakh plus 15% into 2 lakh divided by 4 lakh. This works out to be what? 50,000. 10% into 2 lakh is 20,000. 15% is 30. Yeah, for 50,000 upon 4 lakh. So what is this before tax cost of debt? Before tax cost of debt, what's the before tax cost of debt in this situation? Because see, out of total, 4 lakh, you're going to raise money in 2 ways. Up to 2 lakh, first 2 lakh, you're going to have a cost of 10%. And for the next 2 lakh, you're going to have it as a 15%. So 10% and 15%, when you take the total, it's going to be 50,000. So 50,000 divided by 4 lakh. What is that? 12.5%. Now, of course, this is before tax. So what will be cost of debt after after tax. What's the KD after tax? That's 12.5% into 1 minus point. The tax rate is what, 30%? 1 minus 0.3. So what is the cost of debt after tax, everyone? Cost of debt after tax. Cost of debt after tax. How much is the number? 8.75%. Okay. So we got the capital as equity and debt, and the cost is also given to us. Equity was having a cost of 10.5%. Debt is having a cost of 8.75%. And amount, you have equity as 6 lakh. Okay. And debt is 4 lakh. Okay. Calculate the overall cost of capital, everyone. Give me the overall cost of capital value. Give me the value of overall cost of capital in this case. What's the overall cost of capital? Yeah, what's the number? KO. You have to first get the weights. Weights was 0.6 and 0.4. So this totals to 1. Then you simply do weights into cost. So it is 0.6 into 10.5, which is 6.3. 0.4 into 8.75, which is 3.5. So this totals to 9.8%. So weighted average cost of capital for the firm or for the company is 9.8%. Did you all get it, everyone? Yep. Okay. So with that, we are through this topic of cost of capital. So we have seen how to calculate individual cost of capital when it comes to debentures or borrowed funds, preference shares and equity shares. In case of borrowed funds, we had two methods. One was an approximate method, and another was calculation of IRR, and also what we call it as YTM method. Okay. Daksh, did they ask for weighted average cost? Yes, they asked for weighted average cost in this situation. Yeah. So approximation method was pretty simple to implement, right? But the accurate way of calculating cost was always that of YTM or IRR method. To start with, we stated we first calculate the approximate method, and we use that same approximate method rate to estimate the rate using interpolation method. And then we went ahead with the cost of equity, wherein we had the cost of equity numbers calculated by different methods. One was a constant dividend, then you had constant earnings model, then we had the constant dividend growth model, realized yield approach, and capital asset pricing model. So these were some of the methods that we used for cost of equity. And then last but not the least, we did the weighted average cost, which could be done by using the market value weights or by the book value weights. So in either of the situation, don't expect the answers to be equal. They are going to be quite different. Okay. And how to estimate the growth rate by using different methods is what we have already discussed. Okay. So with that, we are calling this chapter to an end. And next class will start with we'll be starting with the new topic. Okay. So with that, let's just stop here for the day, guys. See you in the next session. Bye-bye. Good night and take care. Session is done. Thank you. Good night.